Hello, everyone, and welcome to On the Move presented by Momentum Multifamily. This series, the purpose of this series is to talk with subject matter experts about various topics and really just keep you up to date on the multifamily industry. My name is Brendan Gardner, and today we're here with Nic Espanet to talk through asset management, particularly through some turbulent times like a pandemic or a recession. Thanks for joining us, Nic.
Hey, thanks for having me, Brendan. I'm looking forward to chatting with you guys today.
Great. I know I've been looking forward to have you on the call here just to get your perspective on various topics, but can you start by explaining a little bit about your background and experience in the multifamily world?
Sure. I started down the multifamily path about 7 years ago. Prior to that, I was a physical therapist, got my master's degree in physical therapy, did that for a little over 20 years. Part of that time was had a small little business of home health, PRN home health, where we went and filled in for other people, oversaw several physical therapy assistants that actually went out and did the treatments. We got them started, but started looking for something different to do with my retirement. Thought I was going to go down the single family path, but came across a couple of different mentoring programs. Went and checked those out and picked one, and that's where, ultimately at about a year and a half after joining that mentorship program, was able to get my first syndication, which was a 100-unit property.
That's amazing. And not many people would take on what seems like a full new business in retirement. Like, why multifamily? What got you into that?
Part of it, my father-in-law owns a 12-unit property, and we saw how well that was doing. He also wanted us to learn how to value that one, how we could figure out what the value, determine the price of his, and start working along that path. But I also, the single family side, I was just looking at, I wanted to do something different with my retirement. I didn't want it to be in the stock market because I would read books on the stock market or look up on it, and my eyes would glaze over. It was just, but as I read about initially single family, I got excited, like, man, I can do this. It makes sense to me. And then I also, as time went on, I came across a multifamily. I'm like, this is the same thing, just bigger, and you can scale up faster. And, it's you can have third party management run your properties instead of having to be the landlord, do the tenants and toilets and things like that, where you're having to get out and interact with the people. Now I have 8 properties. I don't have a key to. I couldn't get in the office unless somebody's there to any of them, which is great. I couldn't get in any of the units. Right, I don't have a key to anything. I don't even know the ones that have gates. I have to wait on somebody to drive up and open the gate to go in. Yeah. Or usually they can get to the office without going into the property, but I don't even have gate codes to them.
So it sounds like it was a good balance of having other people manage a lot of the work and you handling kind of the upfront work to get the deal done.
No, for sure. Yeah. When it's, it was a challenge. I was in my mid-40s when I made the pivot. So it made me a little nervous switching. You still have 3 kids at home, and, college looming on the horizon for all of them. And so to make that pivot, but I also saw with a lot of the changes going on in healthcare that it was becoming more about, the insurance dictating how the treatments were going over what the patient needed. And it also been more independent minded. I still had to, even though I was working with people, we were filling in for other companies. So it pretty much had to be there 8 to 5 or, 9 to 6, whatever it was. So just also the freedom of getting out. I knew with real estate was one of my motivations too.
Yeah. So you were ready for that change, and you sounded confident when you said, like, hey, I can do this. So I'm curious what skills you felt like you had that translated, and maybe some that you felt like you were kind of like, oh, I have to learn this a bit.
Sure. No, I think people skills were the first one, just getting out. And I really am fairly introverted, but something about real estate, I love talking about it. I had not had a finance class or a real estate class, but learned that through the mentorship program that I was involved in, a lot of it. But I've also, I love reading books if I don't know how to do something, probably 99.99% of the time, somebody else has done it. So you can find a book or a mentor that's done it that can guide you. And I barely knew Excel, but I think I'm fairly proficient at it now. And a lot of that is I'm like, I know this, there's got to be a way to do this, but I don't know how to set it up. And great thing about YouTube, I can Google a few keywords of what I want to do and watch a video for a couple of minutes and then go in and know how to do it. Like people are like, man, I'll have people say, hey, a lot of, you're fairly good. I'm not, there's people much better than me, but, and I was like 6 years ago, I barely knew how to put a formula in Excel, but
Yeah, what's great is it sounds like you knew that you didn't necessarily know everything, but you got started and you figured it out as you go. And so I think that holds a lot of people back. Like, what would you recommend for people that are looking to be maybe potentially become an asset manager? Like, what are some pieces of advice or tips you might have?
I mean, if they want to just be an asset manager, I believe there's a certification you could take. I've actually even thought about going through it just so I could help asset manage my properties better. But I think finding a mentor, Dustin Miles was, I partnered with him on my first deal, myself and one other guy, Brad Abbott. But we had Dustin there to lean on. He was not an official asset manager, but he was there if we had questions. And so it's finding a mentor, finding somebody that's already done it, successfully is clues. I think that's the best thing. I haven't come across a great asset management book, but if you can partner with somebody and on the first deal, you likely are going to need to do more of the work and give up more of the equity. But if you can get your foot in the door that way, can be a great opportunity.
Yeah, and from what I've noticed in the industry is that people are more than willing to help in the network and be a shoulder you can lean on and chat with to help through some of those things that you might not know. Have you found the same thing?
Oh, it's been amazing. The abundance mindset of most people in the industry it has been wonderful. The mentorship program we're part of, I love going to the networking events that we did every other month. I'd still like it, but especially when I hadn't got my first deal yet, it would be great to recharge my batteries because we would go and look at some properties and then go have to a restaurant at that time, hang out, but people, hey, try this. Have you tried this on your underwriting? Or, here's what we're doing, how we got to deal, dozens of people giving information. Now, if all of a sudden we're both going after the same deal, we might hold our cards a little closer and not share. But, one deal that we got somebody I know beat us is actually one of Dustin's deals I was trying to buy. And another person that Dustin had partnered with won it, which is fun. Once it's over, I called and said, hey, we did all this research on the water situation there and the roof. If you want this information, I'll gladly share it with you now that you have the property under contract. And I know we're not going to get it, but it's stuff. If you don't have this, it's information I think you could use. And I didn't need it anymore. I wanted to help them, and we had the information, and I could have been like angry that they beat us, and they something about their bid Dustin's group liked better, and that's I wanted to help the team. I was friends with it and wanted to help them going forward.
That's great. Yeah, that comes back around, right? Or you like to think so. Yeah, and one of the things that's interesting too is you started in multifamily, you started to get all this momentum, and then over the last couple of years, the pandemic hits. I imagine that created a whole new set of challenges.
Yes, but it compounded some other challenges we're having. We had a management company at the four properties we had at that time out in Abilene, Texas, that was not performing. We gave them some extra time. They had some private equity coming in that looked like they were going to come in and start being managed better. And they didn't, and when we sat down afterwards, like, what would we have done different? We would have changed management companies sooner, because what happened is we changed management companies right as the pandemic was starting. Well, the company we fired or replaced had let in a significant amount of unqualified tenants. Well, we couldn't evict them. So we had people that by the time it all shook out, we had some people that owed us 8-10 months rent. And we knew some of them were working. They just knew the system and were not paying, and we couldn't, our hands were tied. And so, the pandemic, that is one thing coming out, is if you need to make a change, make it sooner, because you don't know when a bigger pile of poop is going to land in your lap that you don't have a control over. And, we do keep a little more reserves. We try, in the past, before the pandemic, may have held on to a month's worth of expenses plus, month plus, I'd like to have I'd like to have 6 months, but it's not realistic to sit on it. But, hanging on to a little more capital just in case something like that happens.
Mhm.
If the pandemic first started, we were running scenarios like, what if we only collect half our rent? What if we collect none of our rent? How long can we hold out? And it never got that bad, but we stopped distributions during that time just because we were like, we've got to still, pay our mortgage for our debt payment first, and then pay our utilities and our staff. So we've got to hold on to money, because if it's not coming in. But the frustrating part with me, I think the pandemic has trained a generation of renters that they don't have to pay on time, or they don't have to pay at all. And I think that, and there's continues to be some of this, that we're setting up people to live like to think they don't have to pay their rent on time. Even now we're having to do 30-day notices in Texas, which is it used to be 3 days. And so now we're getting people that get an extra day, and not an extra day, an extra month basically to stay on the property before we can evict them.
Mm.
And it's, I think it's doing a disservice to the tenant, because they're learning helplessness. And then we still have to make all of our payment. We still, and I'm not complaining, but I ought to be able to make my business decisions, so it's frustrating that they're putting rules on us. It's still COVID stuff. This is a COVID rule that's we're almost 3 years later that we're still getting blowback or pushback on some of this stuff. And that comes in one of the first things we look at as a landlord friendly state. But when the federal government comes in and overrides some of this stuff, it's frustrating. If you're buying in a non-landlord friendly state and you underwrite for that, it's different, but that's not how we underwrote our stuff in Texas. Even now, if somebody doesn't pay their rent, that before we'd only have 1 month on hit the bad debt, but now with a 30-day notice, there's no way to get around having 2 months unless they pay something. But you can't take a partial payment, so we're going to have anybody that's not going to pay and we have to evict is going to have at least 2 months of bad debt hit the financials.
And then you got to fill the room after that they actually leave.
Yeah, they're sitting. Yeah.
I was gonna say it's difficult, and I can kind of see the conundrum there, where it's like, this is something you want the asset management to handle. These people probably shouldn't have been in this situation in the first place had they been properly qualified. And you want to be empathetic through the pandemic, but you also have investors that you have to take care of and staff that you have to pay.
No, coming back to the pandemic, we were going to show great people even before we were forced to. We're like, let's work with people in this time. We'll try to set something up. But then all of a sudden heavy-handed rules come down that, we had people walk in with money, with saying, Trump says I don't have to pay. And, knowing they had the money and they were working, and one of them, the one I remember, the guy that had he owed almost $10,000 on a 1-bedroom apartment in Abilene, Texas. So, rent's well under $1,000, but the guy smoked and had like 100 cigarette butts out on his porch. I'm like, you're buying cigarettes, but you're not paying your rent. And it's frustrating. And he had a reserved parking spot still. But once I saw that, I was like, go paint over that reserved parking spot. He's not paying for that anymore.
Yeah. So what was it like as like communicating with your investors? What kind of reactions, comments, things would you maybe do differently, or you thought went well?
I have tried to be very transparent and upfront. We send out a monthly newsletter with all the financials, and just, we go in and say, these are the challenges we're having. Here's what we're doing to mitigate those. So I think being overly communicating, being, just giving as much information as you can, but you have to report the negatives or the challenges, but you need to also come in with, here's the steps we're taking to improve those.
Mm-hmm. Absolutely. Yeah. It's one thing to state a problem. It's another to state the problem and say, hey, here's how we're going to fix that. And I guess another problem you mentioned was asset management. I want to make sure I didn't miss this, is what would you do differently next time as you evaluate an asset management company to know that, hey, they're a better fit for what we're trying to do here?
So as an I've been the asset management company, but the property management company, one thing that we have said, we always, being out in Abilene, the one we brought on did not have any other properties there. So that was a challenge. They didn't have a base, they didn't have other people to pull over if somebody quit, or we needed somebody to fill in. They didn't know the vendors out there. So when we did replace them, we used a property management company that had 3 other properties that they had been on site for more close to 10 years. We talked to some of the employees at those other properties, and that the employees had been with this company for 8-10 years. So that was one of our biggest challenges, was that, excuse me, we were having a manager a month. It wasn't quite that bad, but turnover on site was horrible, and you just can't make any headway, because as soon as you get somebody trained to do something, they're gone. And we really liked the property management company brought in, because like I said, probably 80% of their staff at these other properties had been there 5, 7, 8 years or more. So it showed that they were holding on to people they were training. And we knew we had to up our salary. That original company we had would come in with pretty low payroll. And it's just, we learned that it wasn't realistic, paying somebody another 10 or 15, even 20,000 a year to get a good office manager, maintenance person that can come in and keep you occupied, because if you're dropping into the 80s and 70s on occupancy, you're losing tens, if not hundreds of thousands of dollars. So an extra 10 or 20,000 on your payroll is worth it.
Yeah. And that, like you just did there with the math equation, that's all something you can underwrite for and make sure that you're still coming out profitable.
For
and
sure.
You get what you pay for, right? But
no, yeah, exactly.
Now you come out of that whole world and you roll into rising interest rates. So it seems like there's constantly some changing variables for you here as somebody in the multifamily world.
No, for sure. Interest rates have shot up much more than anyone anticipated. I've got one floating rate loan, and we bought an interest rate cap. I wish we'd have bought a 3rd year on it, but we only bought 2. So we are having to escrow money for that. And we're preparing to buy that 3rd year when we have to, but we're trying to hold out, because, most of the experts say that once the Fed quits raising or shows indication that they're going to tap the brakes, the interest rate cap cost will drop significantly. So we're holding out as long as we can to buy that. But and then then I did a fixed rate loan recently too, and cash flows harder to come by, just because your debt payments going up, your leverage is going down on the deal as your interest rates going up, just because they become debt service constrained. So you just got to communicate with investors that the reality is now 4 to 6% average annual cash flow is what is, if you want to be competitive on offer, where you're going to come in. Unless you can come in with some pref stuff, whereas 5-6 years ago, you're looking at double-digit cash flow, and those days are at least gone for now. See if they ever return, but it's a challenge. And with the floating rates, most stuff is indicating rates are going to come back down. But you consider, when you're looking at a floating rate, they could go up. What do you have money in cash and reserves to cover a significant increase? And also watch when you're getting some of these loan terms, they're setting floors on them. So it doesn't mean they may quote you at SOFR, which is, I haven't looked at it in a couple of weeks, around 400 basis points, but they may put a floor at 350 or 300. So if it happened to drop down, you're not going to go below that. Your indexed off of won't go below 350 or 300. So, know your loan terms and know that there may be a floor on it.
And how's that been communicating with investors? Like you mentioned, like you got to have that transparency, but what kind of reactions are you getting? Do you still find that people have the confidence in the asset class at 6%?
Yeah, I mean, yes. We're the ones that in the floating rate deal we're already in, we're explaining it to them. The ones that understand it know that, we've even gone and shown, there's a dot plot from 2021 when we were buying the property. They were showing that was the FOMC staying like at almost zero for many years, and it's up way up to 400 now or so. I don't know the exact numbers, but just saying, this is what information we had at the time. It's come up. So on that, most of them have been understanding on that. We just had explained it's, no one foresaw interest rates climbing this much. Now going into new deals, it's explaining this is still a very strong asset class, being in DFW or Texas or really anywhere in the South, Southwest, Southeast. we have tremendous population growth, shifting to these Florida, Texas, Arizona, and many other southern states. That's putting pressure on the rents, which is helping drive rents up and occupancy. So unlike a lot of other investing tools, if you look at the stock market, it's not a hard asset. You don't know where it's going to go. If Russia does something, or you never know what's going to affect it. And office is taking a hit, retail's taking a hit, but residential is still, people have to have a place to live. And if you buy in areas where people are moving, you're going to turn out pretty well. And it's a hard asset. We're buying with today's dollars, and there is we're paying it off with inflated dollars going forward. So we're definitely gonna, and we'll sell it at inflated dollars in a few years.
Gotcha. And so have you had to get like creative with deal structure, or has this presented any new challenges? You might have highlighted some of that earlier, but just curious if we missed anything.
No, I mean, no, I like the KISS method. Keep it simple. I'm learning more, but I want to be able to explain it to my investors. So I know there's people that have come in and given pref equity or brought in private equity, and that's fine, but they just need to know that is, those guys are going to have usually seniority over your cash, your investors. And so that is concerning. If things don't go well, they can come in and take over, and they're going to get their money before your investors get anything back. So a little leery to do that. But we've stayed pretty much with Fannie, other than one bridge loan on a floating rate. All other 7 deals I'm in are Fannie. Well, one of them is a CMBS, but are fixed rate debt, which has its own challenges because then you have yield maintenance on the back end to deal with. But we try to time the term of the loan with our plan so that we can sell towards the end, so the yield maintenance is not going to be as punitive.
And you had mentioned too some operational challenges in the past as it related to the pandemic, and you just alluded to the fact that, hey, the single family home market isn't doing necessarily as great either. People aren't buying as much right now, so that translates to renters. So that seems like a positive. Have there been some surprising challenges that you've had to navigate too?
Challenges that with the interest rates?
More related, like operationally, as a result of the interest rates, like in terms of potentially having to pull back on some renovations on the property, or focus
on the floating rate. We have stopped. We'd already completed all our renovations, so we were good there, but we have stopped distributions just until we find out what we're going to have to do with the third year interest rate cap. But on the fixed rate stuff, it's not it makes as rates have gone up, our yield maintenance payments, penalties have come down. So a refi or some type of refining out of that loan or selling makes it more attractive. So a couple of our deals, we're getting BOVs, broker opinions of value, to see what the numbers will look like. Plus we, about every quarter to 6 months, we'll get a refi quote too, just to see what, once we're 2-3 years into the deal, we look into what a refi, and fairly often have brokers offering us to give us BOVs. And so we'll take them just to see where they think, and then we'll plug it in and see what kind of return that would give to our investors. Yeah.
So constant evaluation of where we're at and where we could be. And
correct. Yeah. We have like a sales calculator where we'll plug in, what's left on the loan and just all the variables, and then see what return will that give investors.
Hey, they say the good ones know how to buy in up and down markets. And so, go ahead.
No, I was exactly say, and that's a great thing about real estate. I was talking to one person who's much more experienced. Like, there's going to be down periods in real estate. You just got to weather through them, and especially where there's positive job growth and population growth, weather through them, and the values are going to come back up. So I think we're kind of in one of those spots now because rent growth is slowing, and our delinquency is ticking up in some markets more than others. And a part of that, I think we've trained people not to pay. And part of it is with occupancies not climbing and rent growth, is part of that. We're not having household formation is slowed down. People are staying roommates or staying with mom and dad. And then, but with population is moving here. So it's keeping pressure on them. So we haven't gone negative, but we're definitely not having the growth we had coming out of COVID. Part of that is too, when we have double digit rent growth for a year or two, year and a half, it's got to even back out to just organic rent growth in an area.
Water finds its level.
Yeah, yes, exactly. And so, it's been up for a while. So it's, you read some of the articles like, oh, rent growth is going, decreasing. Yeah, it's decelerating, not necessarily going negative. You got to read into what is actually happening. DFW has historically been around 2% at organic, rent growth, 2 to 3%, depending on the submarket. We're getting back to that, and we may overcorrect a little bit down into the ones, but it should come back to historical numbers at some point.
Yeah, and so with that in mind too, like thinking 24 months out, 2 years, like what are your predictions for the market?
I mean, I think if you look at a lot of stuff about the Fed and when rates come down, and after they Penford has a lot of good stuff, but once they start raising, it's usually 18. I don't remember the average, about 18 months before they stop, and then I think we're going to hit that where rates settle back down. We may have time, in the next 6-9 months, as these floating rate loans are coming due and needing to be refied out of. A lot of those may be put on the market for a discount. So I think people are kind of hanging back for those, and that could filter out some of the players. But I think within 2 years we should be back. I don't know that we're going to have 16, 17, 18 growth, and at that time we had a lot of cap rate compression, which really shot values up, and deals were doubling in value in 2 years. I think we will go back to a more historical growth, but as cap rates kind of level off, but we'll underwrite for those too. So I mean, I'm all in for multifamily. I'm not doing anything else. And any mobile homes and all that stuff is gonna be, that's what I know. But I think it's it's being in that B and C property. I'm looking more now at 80s and newer, just wanting to get stuff with PVC sewer lines and pitched roofs over flat roofs. But if the right deal came through with that was 70s and we underwrote it, we're going to have higher repairs and maintenance on it. Plan on make sure the boiler, if it's a boiler chiller, asphalt or flat roof, that we have money to fix those things. But it's just we've got a couple of 80 deals, and just not having those almost monthly, every other month sewer line replacements that we have on a couple of properties, because the cast iron is failing on something that's 50-ish years old.
Yeah, I'd say, I mean, it's really interesting to hear you talk about this, particularly at the level of detail, like coming from the physical therapy world and then having success in the multifamily world. Like, would you have done anything differently or like gotten to it earlier?
Oh, definitely earlier. I wish I'd have done this right out of high school. I don't even know that you need a college degree. Actually, I know you don't. And maybe taking a couple of finance real estate classes and started this. Now you got to have some income, some capital to put into it. So you need to make a living somewhere. My middle daughter is very interested in real estate. So I've talked to her. I don't even know, you don't have, if you want to do real estate, you don't have to have a degree. You can't, I'm not telling you don't, but take a few finance classes, some real estate classes. And if this is what you want to do and start, or do some real estate as you're going through school to create some income. So you're coming out with, net positive coming out of school, even is better than neutral. If school's paid for by mom and dad and you're not acquiring debt, you're neutral at least coming out. But if you can come out and you've already started building your stockpile and experience, it's going to start, you're starting up here on your trajectory instead of down here.
Right. Yeah. I mean, it's I think kind of a good kept secret for a lot of people, that they don't realize as an individual that they can get into it versus having it for kind of the upper class. But with all this in mind, as we wrap up, any final words for the listeners that might aspire to do what you're doing today?
Oh, if you want to do it, find a mentor and follow them. Reach, if you want to talk to me, you can about my path, but it's achievable. Anybody can do it with persistence. I do some coaching now, and so with that, often people get frustrated that deals aren't penciling out for them. Like, look, if every deal penciled out, everybody would be doing this. and you wouldn't make any money at it. It's the people that will look through a dozen or 100 deals, whatever the number is, till one works out. Now, some people may find their second or third deal they underwrite works, but some it may be 100. You know, from when I first started till my first deal closed was 23 months.
Wow.
It's, you know, it's persistence. You know, we made the offer, so I would say probably 20 months when we first got our first offer accepted. And so it's, you know, and I think it's the real estate guys that say, they have a quote that real estate is not a get rich quick, but it's get rich for sure. But it's just, you gotta go and take time to get there and bring something that you're looking to partner with somebody. What are you bringing to the team? Why would somebody want to partner with you? If somebody has experience and you're new, you need to bring something valuable to to them. Is it you'll do the work for less of the equity things, and that's how I approach myself and Brad Abbott approached partnering with Dustin on our first deal with him was, you know, we'll give you a bulk of the equity, and we'll do 99% of the work if you'll be our experienced person on the loan and on the deal. Talking with brokers.
That's great. Thank you for sharing that. And so you mentioned you're doing some coaching and you're happy to connect with people. Where can they find you?
Yeah, I have a website. It's Nic with no K, NIC at Thrive Multifamily. You can also book I have a Calendly link. It's easiest just to go with visit with Nic. Again, I actually bought with a K and without a K. So visitwithnic.com. We'll go to my Calendly link. But you also, if you go to thrivemultifamily.com, I did my email. So thrivemultifamily.com is a website and there's a link there, but that's probably the best to get on my Calendly. Because if you email me, I will try to get back, but I woke up this morning to 90 something unanswered emails. So it's not always the fastest for me to get through those.
Gotcha. We'll put that in the information below. That's great that you bought both Nic with a C and Nic with the K too, because you know it's just going to be a problem. But
yes.
Additionally, if you want to learn more and get to network with people like Nic and others in the multifamily world, go to momentummultifamily.com and sign up in the investor portal, and you can just stay up to date on even more things multifamily. Thank you for listening, and we'll see you next time.
Thanks, Brendan. Great to be here. Thanks for
you,
having
Nic.
me.